So let's see whether or not we've got a rebound in store just on the headline index, but the real pain is in the broader markets, and portfolios are not feeling good because of that. But as we have been saying, this is the time normally when you can pick and choose the stocks and get it at the at the price that you want. So I think stay alert out there.
The Midcap index is down 2.5% this week. It's quite a fall.
No, absolutely. And today, again, if you look at the result reactions, yesterday there was hope that, a lot of stocks that were falling on Monday and Tuesday started recovering on Wednesday and Thursday, EMS, so on and so forth. There was some recovery in some of these internet companies, consumer tech companies as well. But again, today, if you're looking at the bigger losers, wherever results have disappointed, clearly markets in no mood to be charitable. Mankind could be an example. It's down about 5%. And then, of course, let's not even talk about Cyient, but we'll get Rima to probably recap it anyway. In case you've been away since morning, you've missed the story. A 22-23% decline because of bad news. There's no denying that there's bad news, but the reactions are extremely severe. That's the other facet of it. Beyond that, look at the stocks like Oil India. Now with the big drastic 5% drop in oil prices, there's a bit of question mark on companies which are primarily into upstream. So there's some profit taking going on there as well. I mean, beyond that, Credit Access, there's Sobha, there's Syngene, basically Prestige Estates. There's a lot of selling in real estate, by the way, today. So Midcap overall, not too great.
But, there are some winners. So KFin, for instance, and it's not that the earnings were blowout. It was a 3% kind of a top-line growth, but the stock is up nearly about 8.5%, 9%. Amber Enterprises is the other star today, 3.5% up this week. So strength coming in, and Emphasis. Initially, the stock was down 5%. Because the street said, well, there's nothing much in the earnings. Where is that BFSI recovery? Growth is just about 0.2%. But in the conference call, sort of the management seemed to allay investor concerns about growth. And the stock at 11 o'clock, once the conference call began, started moving up. And it's still holding up with a gain of about 4%. So today, at least, some of the decent earnings are being rewarded. Well,
that's right. And to some of those stocks that valuation had run ahead of themselves, case in point being a Kalyan Jewellers, any kind of bounce in the stock is seeing selling pressure, and one wonders where exactly will the stock take support. But on a day-to-day basis, it gives some hope, and then in fact, it does see some selling. And now just looking at a trend, the last 1 year, if you pull up Kalyan Jewellers as well as Titan, you'll see that Kalyan Jewellers, in fact, it had a big run out there. Kalyan Jewellers as well as Titan in the last 1 year. But in the last 1 month or so, in fact, Titan has done much better. So it seems that, in case, someone wants to play jewelry, then the one that at least is giving you some kind of confidence is Titan, because I think in 2025 so far, the stock is up close to around 5%, while the markets have been jittery, and Kalyan has seen a sharp downtick as well. Pull up, the last couple of week chart, you'll see that, in fact, that stock has done quite well. How do you position yourself, though? Mitesh Thakkar is back with us. Mitesh, very nimble-footed you'll have to be in today's trading session. When you think you've got the momentum on the downside, suddenly the bulls fight back. On the upside, you think that, okay, we're breaking away to 23,500, but then the bears fight back. What's your take? We're at around this 23,150. How would you trade it?
Good afternoon, Nigel. So, two things. One, the important point to note over here is that while this is a market which is slightly choppy, behaving in a manner which is not exactly conducive for trading, this is a market, which is not falling or making new lows. So I think it's just stopped doing that in the last 3, 4, 5 sessions, or even if we made it low, it's just a mild intraday decline below the previous low. It's not a proper continuation on the downside, which means that this is maybe some kind of base building activity happening at slightly lower levels. And if that way it's going to play out, then I think there's a good chance that after a few days of choppy consolidation, we might see a reversal on the upside and some kind of at least if not a larger trend, a medium-term trend, which could see the markets move up from current levels. So not bad, but yes, in this current market, therefore, you must wait for this choppy range to play out. 23,000, 23,350 are my 2 levels to watch. On the upside, we have time and again failed to give an hourly close or even a daily close above this 23,350 zone, while we are not breaking 23,000 zones properly. So I think this is a market which is trying to find its feet, but yet not stabilized fully. The good part is that the volatility indicators have started to shrink and now are showing signs of contraction instead of expansion, which means that there's a stronger probability that the market might be, trying to find a base at lower levels. So with that, wait for the index trend to come clear. And on the stock side, I have a buy on Tech Mahindra with a stop at about 1702. Look for targets of around 1800 over here. And Zydus Life is a sell. Zydus Life is a sell with a stop at about 975 for targets of 930.
Got that. IT is doing very well today, so it's not just one stock that Mitesh picked up, but Emphasis, First Source, Persistent continues to see buying even after yesterday's up move, and so does Coforge. But let's talk about Tejas Networks. Now, Tejas Networks is a company which makes telecom equipment for network, etc. Now, the stock has had a good run in the last 3 years. It's up nearly 150%. And one of the drivers was this large BSNL contract that the company was executing, which is why for the last few quarters, the company's growth rates were elevated. But this quarter, maybe as the base effect kicks in, or the incremental from BSNL is coming down, not the base effect, but the incremental revenues, we've seen quarter-on-quarter growth rates slipping. The company has always spoken about year-on-year growth rates. But quarter-on-quarter revenues are down 6%. EBITDA margins have come down to nearly 9%, lower than the 14-15% that they had in Q2. And not just that, right? These are the numbers. You could say they're volatile, they're chunky, but the order book, which was very high for the last couple of quarters because BSNL, has also been coming down. And this time it's below 3,000. And the other internal that could have spooked the street is the trade receivables, which continues to rise. So these are some internals which the street is not like. And plus, remember, the stock is up 150% in the last 3 years. So some reason for profit booking. Prakash is now with us on the show. Prakash, is Tejas Networks a stock that you like?
So, interestingly, this stock will go through these ebbs and, flows of orders and the execution thereof. Remember, it's not something which it's taken a long time to receive these orders through the TCS network. And finally, as they continue to build on this, I think there will be another phase of connectivity that BSNL will pursue. So they will definitely have a much larger role, much bigger role to play. Interestingly, what's going to happen is in subsequent order execution, the pace will be different. So right now, I think they're deliberately not gunning for more. It's more of execute the current lot of orders and make sure that in the next set you have recalibrated kind of a pitch for whatever they want to do. But BSNL's plans are big enough, and I'm sure Tejas has enough room to kind of accommodate some of these orders. So I'm quite positive on it. If the stock corrects, and it has corrected, it has started correcting given a little bit of tepid performance, then definitely it gets into that viable zone because it was so overvalued. It was difficult to kind of justify the valuation that at one point in time was trading.
Prakash, you're tracking MobiWik? That one from the highs, it's almost halved. Currently it's down.
Unfortunately not. No, unfortunately not, Nigel. I haven't tracked that since the IPO itself.
Okay, all right. What about the cement pack? Ultratech's numbers were good. We had a brief chat yesterday. The stock is cooling off a little bit, but yesterday it was up 7%, so it did quite a big move out there. The commentary from them was fairly positive. And to be fair, if you saw the other two names as well, Dalmia, Novoco, numbers were far from impressive, but the street, in fact, is giving them the longer rope, saying that things will improve from here on. That's why the stocks are not down that much. Your view?
Yeah, so I do agree. There is a little bit of a bottoming out that most of the numbers are reflecting. Ultratech was, of course, a very, very pleasant surprise in that sense that they could manage to improve things, even in times which are difficult for the industry as a whole. But remember, I told this yesterday also, we've not had any significant move on price hikes. And still, the kind of retention that they have, the metrics that Ultratech has reported are far impressive. And, the consolidation that they've undergone, I mean, tending to 200 million tons is significantly large. So they will be price takers now. They will actually be the ones who will set the tone for any kind of a price change. And the India Cement, the acquisition probably taken some time to get digested. It means getting into the mainstream business of the company. But geographical expansion towards the east and all the non-south areas, to be very honest, even central, even north, they seem to be quite promising. So let's see if the budget comes up with something. One of the reasons the stocks are not going down, Nigel, is because in spite of some weak numbers, is there is expectation that the government will come up with something to pump prime the capex, and that could mean a lot of favorable triggers for the cement pack. So that's what everybody's banking on, and I think it's fair enough. So just another week, and we'll probably get to know which side things are panning out.
Got it. By the way, the market's trending at the lowest point of the day. We are about 100 points lower, and that's the Nifty. On the Nifty, On the mid-cap and the small-cap indices, like Rima was saying, the mid-cap index is down about 2.5% this week. The pain in the small-cap is even more. The small-cap index is down 4%. So, I mean, that excruciating, painful destruction in prices, that continues unchecked. That's the small-cap today, down to 2.5% actually. That's the Nifty small-cap. Anyway, let's try and talk about brighter things. And one of those bright spots today is KFin. The stock's actually holding up about 8%. If you're looking at the pattern and the numbers quarter on quarter, then the growth is quiet, you can say, 3% on the top line and flattish around the EBITDA line as well. But year on year, of course, most of the segments have done well. They continue to improve their market share as well. So let me ask Prakash about this. Prakash, hi, happy Friday to you. Let Friday be happy, irrespective of the shape of the market, right? Now, KFin, tell us what you think about the company. Market can be choppy, and if someone is to play the whole capital markets theme for the next 1 year, in the near term, there could be pain. Are you better off with brokers like, Angel or wealth managers like Nuvama, or would you look at something like a KFin?
No, absolutely. I think, for me, KFintech and CAMS for that matter, both of them being, the only two large players in this space, have an unfair advantage of sorts. They are, the more they become big, as size kind of gets in their favor, they actually have very good pricing negotiation ability. Now, what it does is any fund that is likely to kind of set up any kind of a vehicle in India would need somebody very reliable for this. And this arrangement which they've just announced, I think it was last quarter, with the BlackRock, this thing is significantly large. I mean, you probably have a slew of funds, and most ETFs are where the administrator actually does a lot more work than in actively management. So, it's a role which will give them that ability to price themselves. They have some expansion in foreign funds, if I remember correctly, in Southeast Asia as well. But these are businesses, optionalities that have started seeing the light of day. And my personal view is, KFintech or that business is far more insulated than a broking business. So broking, you don't really have pricing power. You only keep seeing it dwindle. Whereas here, if mutual funds do well, and they are doing well, and if stocks do well, everything finally adds up to more activity rates. And they've done a fabulous job. 38, 39, 40% kind of EBITDA for the year is not easy to achieve in a lot of other businesses. So I think the return ratios definitely are quite impressive. You could buy it now, you could wait for dips, but have it from a longer term orientation. It's not a quarter kind of a stock.
But CAMS or KFin? Quickly, in 10 seconds.
No, KFin. So KFin is the hungrier out of the two, and it's doing a lot of things to PR. So I would believe they'll probably do better.
Okay, let's get to Dr. Reddy's. That's the top Nifty loser today. Numbers were in line, at least operationally, but profits came in lower than street expectation, and the street is concerned about the pipeline beyond generic Revlimid. In fact, we had a chat with the company's CEO, Erez Israeli. Listen in.
These specific products do have competition. There is no change to the competitive landscape of these specific products in the last quarter. But normally, when product is big, other products other companies are joining. This is the nature of the game, especially in generics in the United States. And we face competition in these two products as well as actually in every other product. And this is likely to continue, but there is it's nothing out of ordinary. Before the competition entered to these specific products, which was around 6 to 9 months ago, at that point of time, indeed, we lost some market share to the new entrant on this product. This is correct. Overall, it's a normal behavior that is happening in every product. So 2026 is the year in which the market will start to be opened up in terms of IP, in terms of patents. The main countries in 2026 will be Canada, India, Brazil, and 80 more countries that are relatively smaller, in which, as we speak, there is actually no patents, and these markets are open. We are planning to launch the product in many, many countries.
Okay. I think, okay, I'll take over till we get that audio issue fixed with Rima. But that was Dr. Reddy's, and the disappointment even there has been, playing out. Prakash, Reddy's, US business, not looking too great. And, we have to see if the other drugs make up for the loss on, the generic version of Revlimid. What do you think?
Yeah, so, generics is anyways a very, highly competitive segment. There's nothing you can do much about it. You keep hoping that some of these, portfolio plays start panning out and getting you the big bump up in revenue. It's been missing. It's been elusive for quite some time for Reddy's. But the DNA of the business, the way they've kind of built themselves up from the ground, I don't see any concern. In fact, every opportunity we've seen where Dr. Reddy's has been, losing some sort of a steam in terms of the price volume action, it kind of makes a comeback as soon as things start normalizing. So it's been choppy for the last 1 year, but my sense is pharma is going to be where a lot of capital will get. Of course, the likes of Reddy might not see incremental flows very soon because people are chasing the CDMO segment and some of the other new names. But I would believe it will, as the flows come back from the FI side, you'll see a lot of ETF money also getting allocated at these valuations. But nothing really spectacular at the moment, but you could probably look at it from a longer-term perspective in your portfolio.
Prakash, what's happening on Trent? It's a very large, well-owned stock to see this kind of a downfall. It's lost more than 20% since the start of the year, 35% from its peak that it hit only in October. So what's spooking the street, and at what point should investors, long-term investors, step in?
So I think, what happens is because it's lost some ground from the top, we start feeling there could be some sort of a respite. But if you look at it in absolute terms, the valuations, the only justification in the case of Trent, even at that point in time when it was 8,000 plus, was that the PEG, the price earnings growth ratio, is fairly favorable, given visibility of growth in the next coming years. But you don't buy stocks on that hope story where things have to you buy them so richly that they have to perform. The margin of error will become so minuscule that actually you would probably get punished if something goes wrong. And my sense is that's exactly what the market has taken note of. And the valuation will have to come back to reasonable levels. And look at how some of the smaller names have done. Surbhi's with you there. You could ask her, right, exactly around the budget time last year, we spoke about this small business called Vishal Retail and, the V2 Retail and all these players which were likely to do well because there's a lot of money that's going and being spent into the tier 2, tier 3 India. So that is a segment that could probably continue to surprise us, and Trent will probably have to do much more to reinvent itself from where it is today to justify the same valuation that it had, let's say, 6 months back. But on an organic, normal basis, I think the valuations would still taper down a bit, and then it becomes a very worthy name to have in your business because of the consistent compounding that it would.
Okay, all right. Realignment in terms of PE after running away a little too fast and too furious. Thanks a lot, Prakash, for joining in and filling us in with your take on all those stocks. By the way, as we're having the chat with Prakash, take a look at what's happened on the screen. I think we should just get the Nifty chart first up for you. The Nifty has moved to the low point of the day, 150 points lower, and a lot of stocks actually have suddenly come for a fresh round of selling. You pull up, yes, Mahindra & Mahindra, Adani Enterprises. Just pull up the intraday charts out there. JSW Steel, I think in a few minutes we'll get the numbers that should come out, maybe pre-market close as well. So that stock has moved lower. BPCL as well as taking it on the chin as we speak. And the Nifty Bank that was down 200 points, now it's down 350 points. So a lot of selling is what we've seen in the last few minutes or so.
Absolutely. And we should also pull up European indices and Asian indices just to keep the context going, that right now we are simply dealing with our own problem. Global markets are fine. I mean, they've taken things and a lot of this commentary from Donald Trump, the US president, in their stride. If you look at that's some of the markets that are trading around the European region right now, and most of them are up. I mean, peripheral markets, the CAC, DAX, are all higher, and most of the Asian markets have also had a green session. The Japanese market flipped because of that rate hike, but otherwise it's been okay around much of the neighborhood. However, we are dealing with our own issues at this point in time. Well, yeah, that's the dollar yuan. Let's pull up the dollar index actually, and see how that one's behaving, because in the morning after the BOJ rate hike, the dollar index had slipped. It was trading below 108, and it's still, it's a very good global backdrop is a short point that I'm making. We have our own issues to deal with, and that's what this week has been all about. Let's take a break on that note, come back on the other side with a lot more. But as we take that break, let's actually talk about some good news. You can, of course, get India's business news leader now at the click of a button, introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the app now from the Apple Store or from Google Play, or you can even scan the QR code that's on your screen. Welcome back. You're with us on Closing Bell, and we are in the last half hour of what's been yet another challenging week for the market. And even as we speak, the market's been making fresh lows at the index level. So what next? Look at that, 130 points, still lower on the Nifty. What next? Sunil Kaul, Global Emerging Market Equity Strategist at Goldman Sachs, is with us now. Sunil, thanks very much for joining in. I know that's a tough question, but let's start with the flows picture, because you folks have been analyzing this absolute exodus that the market here has been seeing, right, from foreign investors. What's the sense and what's the chatter that you're picking up? Because these days, it's a daily sell figure of 4,000, 5,000 crores. I mean, it's not even, it's a one-way move. There's absolutely no reversal coming through. So what is the mood out there?
Yeah, no, that's right, Surabhi. I think if you looked at the pace of foreign selling, I mean, from the peak, we have seen close to $20 billion of foreign selling in India, which I think if you put that in context, that's the second largest selling India has seen in terms of absolute numbers. And also, if you look at the percentage of market cap, that's 40 basis points. But I would say if you sort of looked at the selling, it sort of started with the China stimulus trade back in sort of peak of September. And then I think as we started the earnings season in October with the cyclical slowdown that we have been seeing in India, people have started to sort of exit. But I think it's a combination of the broader sort of macro backdrop for the emerging markets not that great, with sort of dollar being stronger, rates being higher. Obviously, a lot of the expectations were around sort of tariffs. And so in that environment, we have been seeing people pulling out money across emerging markets. And so the sentiment is a bit cautious, which is kind of in line with our view. So I would say it's a combination of sort of global environment not being as supportive and Indian fundamentals kind of seeing a slowdown in terms of both growth and corporate earnings, which is why we're kind of seeing a sell-off in the markets. I think bear in mind the starting point in September, because we had two strong years of Indian equity markets outperformance. And so at the peak in September, the market was trading at 24, 25 times PE, which is even above the peak valuations in 2007, right? So your starting valuations were pretty stretched at peak levels, and then you sort of started to hit the corporate earnings downgrade cycle. Combining that with the fact that the global macro backdrop has been tougher, I think that's why India, being the most expensive market in emerging markets, has been seeing quite a bit of FI ceiling.
Okay, so you raised two separate points, Sunil. One is the global backdrop, and then we have our own issues, local issues, earnings and slowdown. We'll come to the second one in just a bit. Let me just complete the picture on the first one. Now, as far as these global uncertainties are concerned, I completely take your point, because the dollar was going through the roof as we were getting to the 20th of January, right? But now that seems to be kind of settling somewhat. US yields are not going completely haywire. The dollar's now found a range. Oil prices are actually going lower. And at least till now, we've not seen some absolutely out of the park announcements on tariffs, neither on India nor on emerging markets. So
yeah, that's right. Yeah.
So is it too early to say that at least the global piece is settling, or do you think we should not take that too lightly either?
I think it might be a bit too early, because, I mean, if you, for example, looked at what happened pre-US elections, obviously we were expecting dollar to move higher, rates to move higher as well, which is why when we were framing our expectations for emerging markets, we were a bit cautious on the markets. Obviously, I think post-US elections, many of these moves were even sharper than what we had anticipated, right? So as you said, dollar was at sort of multi-year highs, at 35-year high. If you look at it on a trade-weighted basis, rates were spiking. I mean, the things have stabilized in the last couple of weeks, which is why I think the markets also global markets have taken a breather. But I think our sense is that if you, for example, look the strong move in dollar, a lot of that can be explained by the fact that US economy and US data has been much stronger than elsewhere. And obviously, we saw the repricing in rates, so we are expecting lesser Fed cuts, whereas we do think that ECB will continue to cut. We will think China will continue to cut. And so if you just looked at rate differentials and growth differentials, I think that could explain most of the move we have seen in the dollar. The key point, therefore, is we don't think that the moves in tariffs are largely in the price. Obviously, I think the news flow we saw on the tariff after the inauguration day were somewhat kind of less hawkish than what the market was anticipating. And so there's a bit of sort of relief rally on the back of that. But we think there could be more sort of headline risk around tariffs as we go through the first quarter, which is why we still think dollar may be stronger so on a trade-weighted basis and on a DXY basis, especially if we see weakness in yuan and weakness in some of the other and weakness in euro. That could put dollar higher. So I think we are not still out of the woods regarding the global situation, which is why our sort of view on the emerging market remains that we'll stay sort of range bound or cautious in the next 3 to 6 months.
All right, so you just hold that thought. We need to address some numbers that are flashing for you on the screen. And Laurus Laboratories is the stock that's moved to the high point of the day. And the reason is after 6 quarters, the margins have returned to around 20%. We have got very, very used to saying that Laurus Laboratories is guiding for better margins in the next quarter. And that's happened for all of 6-7 quarters. And now the margins have come in at around 20%. The top line as well at around 1,400 crores. That as well as after nearly around 6 quarters. Explains why the stock has moved to the high point of the day as we speak. It's up close to around 3%. So the margins back at 20%, thumbs up. And that's why that stock is relatively outperforming at this point of time. We'll wait for further details, but prima facie, those numbers look good. Revenue growth, margins as well look quite good. Good expansion on a sequential basis, 15 to around 20%. Sunil, apologies for that. We just need to take stock of some results that are coming in there. But Sunil, give and take everything. What Trump is doing, what he's saying, the currency volatility as well, and the Fed, we don't know what they're going to do. I think here in India, all eyes are on some monetary policy. And hopefully there'll be some kind of loosening out there because it appears as of now at least, the liquidity in the system is very, very low. And I think regulator will have to take a call on that. Assume that we do get a rate cut in February or so, and the budget doesn't have any negatives. Do you think the Indian markets can at least perform in line with the global equities? And I ask this because the way the FIs have been selling, we have been underperforming as well. And we've gotten used to at least being outperformers, but now can we be market performers at least?
I mean, that's a great question, Nigel. Look, I think you are right. We agree with you on that. So if you sort of take a step back, we took our view on Indian equities sort of from being overweight for the last couple of years to neutral back in October, which in hindsight was a good timing. But the main reason for that was that we were expecting the cyclical slowdown in growth, which largely was, in our view, was largely driven by both fiscal being tight and monetary policy being tight. Obviously, as budget comes through, we still think that there is not much room to ease fiscally, so they will still go for fiscal consolidation. But on the monetary side, to your question, we do think that monetary policy is going to ease. So I think as you mentioned, the RBI has been keeping liquidity pretty tight because they were supporting the currency in this strong dollar cycle, and that's why the interbank rates were pretty high. But we think as they move into the February policy, they will ease liquidity, and so I think liquidity conditions will start to become better. But also we are expecting 2 rate cuts, one in February and one in April, 25 basis points each, so 50 basis points of easing. So that at the margin should be helpful. So I think if you therefore think about the causes of slowdown, I think there is fiscal tightening, there was monetary tightening. There's obviously was all the macroprudential measures that RBI was taking with all the unsecured retail credit, as we know, and there is obviously the consumption slowdown. Out of all these factors, as I said, fiscal will remain tight, but monetary easing at least we should start to see. I think that should be helpful at the margin. And then I think we are already seeing the credit slow down over the past year from 17-18% of the credit growth to 11-12%. So I think the bulk of the credit tightness that RBI has been doing is also kind of sort of stabilizing. So our sense is that you probably see range-bound markets 3 months or so, and I think as we get deeper into the year, more into the second half, the market should see a stronger recovery because by that time, your earnings cycle should start to improve.
How do you define a stronger recovery, Sunil, in the second half?
Yeah, so if you look at our targets, Surabhi, so we have 23,000 on Nifty by March, which is where I think it is roughly. So we have flat target in our numbers, and obviously markets have been weaker. So as I said, when we downgraded the market back in October, since then the market is already down 13-14% in local currency terms. And obviously, I think beneath the surface, as we know, there has been a lot of carnage in some stocks. And so I think market has already corrected. We have gone from 24-25 times PE to 22 times PE. So our fair value, where we think India's fair value is more like 20-21 times. So I think a large part of multiple correction has happened. We think there's a little bit more to go. We also think that earnings for this year, calendar 2025, are at 16%. Consensus, we are at 13%. So we do think there is a little bit of more earnings risk, which is why I think on the 3-month basis, as I say, market probably is going to be range bound as we digest some of the more earnings downgrades and a bit of more multiple compression. But then in the second half, we think there could be a stronger recovery in line with the underlying earnings growth, which is 13% for us. So we think market would be close to sort of 13-14% in the second half, going back to 27,000, which is our Nifty 12-month target.
You're saying 13% earnings, that's for FY26, is it? Or are you looking at calendar year?
Calendar 25.
Calendar 25, got that. So 13% earnings, calendar 25, and a stronger recovery, taking the Nifty to 27,000 by the end of the year, by basically the towards
By
the end of
12
the
months,
year.
yes. Yes.
12 months. Got that. Nice.
You know, Sunil, looking at the screen, the bulls will be very, very happy to hear that, you know, because things are looking very, very jittery. These bounces are getting sold into. And a market participant, you know, I was speaking to him yesterday, he said that, you know, Nigel, the way liquidity has been so tight, it's like I broke a signal and you're sending me to jail for that. You know, that's how equity market participants are feeling. But, you know, there'll be sectors and themes that will do well. And I think y'all have been underweight, if I'm not mistaken, on the financials. I think there was a consensus out there that they will do well. But actually, banks and financials have underperformed. What do you like
correct.
as of now? The top theme that you'll have, I think you'll be reasonably positive on autos, on insurance as well. So give us the top two sectors you're positive on.
Yeah, look, I think as a broader view,
Oops. All right. I think we'll try to get Sunil back, you know, to hear out his the two sectors that he likes. We'll just try to fix that in a bit. In the meanwhile, markets well stabilized. We saw a sharp downtick. ICICI Bank, that's the one that's trying to pull its hand up and try to be counted. As we speak, a mild recovery is what we're seeing on ICICI Bank, but it has a decent weightage, and that's why that's helping out. Sunil, back to you. I think we have you back on the line. The top two themes you're giving us.
So as I was saying, Nigel, is that when we lowered the market, the core sectoral thesis was that you want to reduce cyclicality in your sectors, and so we have taken a much defensive allocation in our sector recommendation. So we have upgraded IT a few months back. That remains our top sector in terms of the defensive sector. Obviously, a lot of that is in line with the stronger US economy view. We have 60% of the revenues.
Oh, I think we're having a bit of an audio issue. Unfortunately, Sunil just lost that audio. Don't know, do we have him back? Sunil, can you hear us? No, I don't think we have that line fixed. So we'll wind it up on...
You.
Oh, we can.
Oh, okay. Now we can hear you. Sunil, if you could just quickly complete that point. And also, I just wanted to end by asking you, this recovery that you're speaking of, right? The hope of corporate earnings reviving. And you said that don't expect too much of, fiscal easing.
Right.
It's going to be more monetary. So I want to end by asking you, this is a classical debate, right? Is it going to be enough? Will 50 basis points be enough to get us that, earnings trajectory back on track? What makes you hopeful?
See, I think on the slowdown, you're right. We are underweight banks. We are underweight infra, which goes which is in line with the fiscal still being tight. But even on the consumption side, Surbi, as you know, I mean, it's not homogeneous, right? You still have high-end consumption doing pretty well. You still have signs of rural recovery, and autos have been doing well. So in terms of the sectors, we think that if you can, I mean, given sort of our positive view on the IT sector, I think from the consumption side, autos could do pretty well. We think the defensive sectors like insurance and telcos can still continue to do decently well. Real estate cycle is still being strong, so we're still overweight real estate, and we like some of the real estate late cycle plays, pipes, ceramics, tiles, all of that. So I think there are definitely sort of export pockets, IT, and some of the domestic pockets where the demand visibility is still strong. Even though your financial earnings might remain under pressure and the capex sensitive sectors like cement and industrials may not see a strong pickup, I think that you can still see a decent sort of double-digit earnings growth, as I said, 12-13%, which is slight pickup in volumes and a bit of margin expansion.
Got it. And I think the market will take it with both hands, considering we'll probably end at some 5-6% for FY25. Going back to 13%, I think will be very, very well received. Music to the bulls' ears. All right, Sunil, thank you very much. Have a great weekend, and we look forward to more of these conversations in the coming weeks and months. We'll take a break on that note, come back on the other side. And then, of course, some final trading calls for today and more on the markets in just a bit.
Welcome back. All eyes will be on ICICI Bank earnings, which are expected to be announced tomorrow. Abhishek joins us to help us out with what we expect. Abhishek, over to you.
Well, Nigel, Street is anticipating strong business momentum while weak PNL or the bottom line from ICICI Bank. So deposit growth is seen at 17.5% YOY and about 4.5% quarter-on-quarter. The loan growth is seen at 15% YOY and about 3.9% sequentially, both as per Motilal Oswal estimate. So net interest margin can decline YOY and quarter-on-quarter. Kotak Securities is estimating a 27 basis point decline YOY and 10 basis point decline sequentially on the net interest margin. Provisions could rise sequentially. Kotak Securities is estimating a credit cost of 53 basis point for the quarter, which is up 13 basis points sequentially. Asset quality largely expected to remain stable. Motilal Oswal estimates gross NPA ratio of around 2% versus 1.97% in the previous quarter. Now, management commentary with respect to business momentum going ahead will be seen closely. Our poll suggests NII growth of 9.5% YOY and about 2% sequentially. We are working with a profit growth of more than 10% YOY and a decline of more than 3% sequentially. Back to you.
Okay, all right, Abhishek, thanks a lot for that. Well, let's hop across to Vinny. She's here to tell us about Indigo that will be reporting their numbers. Vinny?
Absolutely. So Indigo will report its numbers from a short while from now. Revenue, we're expecting a 13% growth on a year-on-year basis. Profits expected to see a 5% growth, while in terms of margins, 27% is what we're expecting the EBITDA margin at versus a 26% last year, so 100 basis point expansion there. Now, yields, that is expected to come in at 5.48 rupees versus 5.46 rupees, so almost flattish to slight bit of an improvement on that front. Passenger load factor, that's expected to be very good this time. 87% is the passenger load factor that we're expecting, around 86, 87%. Now, what we're expecting in terms of margin expansion is mainly because of the fuel prices, lower crude prices, that is propelling the profits of the company as well. And it's a seasonally strong quarter. So keep an eye out on Interglobe Aviation. We're expecting a decent number, especially in terms of commentary that could come in from the management terms of Pratt & Whitney engines, as well as international expansion plans and commentary on the competition front will be keenly watched out.
Okay, all right. Thanks a lot for that, Vinny. By the way, just keep an eye out on Atul Limited. You know, there is some clarification that's coming in there. There was a one-off in that EBITDA number. Atul Limited, it's down now close to around 3.5% or thereabouts, but it's seeing some kind of recovery from the lows of the day. The reason is that there's a one-time, a one-off of close to around 16 crores. And adjusted for that, actually, the margins are pretty much in line. So the stock, I think, had gone down to around that 6,500 odd mark. From there, it's seeing a bit of a bounce. So keep an eye out on that. Just want to alert our viewers, and we'll get that line as well up for you. The adjusted EBITDA will be around 240 crores. That's close to around 16.9%, around 17%. And that's in line with what the market was expecting. So various sales notes are now coming in there, highlighting the fact that there is a one-off actually, which explains why it appeared like a bigger miss. But adjusted for that, it's actually in line. A bit of a recovery is what we're seeing from the lows of the day. Mitesh Thakkar is back with us. Mitesh, you want to help us out with a couple of trades?
Imagine the closing is slightly on the weaker side. So we take an estimate on. You were just discussing the stock Atul Limited. I think that's the one which is down in the last few minutes, and now I estimate trade the stock at 65.60 can be taken. Look for 64.40, 64.30 as the target for Monday. The other stock which my leg is BTST and Britannia with a stop at about 50.75 for targets of 51.50.
Okay, all right. Well, that's the flash up for you. There's a one-time out there, but Mitesh is saying that in fact on the charts, Atul Limited, he believes it's still a little bit weakish. Thanks, Mitesh, for that. Well, let's get in Sudeep Bandupai, who joins us on the show. Hi, Sudeep. Good afternoon and good to see you in. Sudeep, any one stock that you believe has corrected enough and you think that you would like to bet on it? Anything you'd like to help us out with?
Well, I think the name comes to my mind is Reliance. I think it's definitely corrected more than what it should have corrected, post even the numbers, the stock hasn't really moved up. Of course, it's got to do with what is happening in the overall market, FII selling and a whole lot of other issues. But considering sum of parts valuation, I think Reliance definitely is one stock which definitely surely deserves a better valuation. If you want to expand the universe, then probably I would like to include stocks like Bharat Electronics, which has corrected quite a bit today also. And I definitely expect it to go up significantly. I do expect budget also to lay emphasis on defense spending, and BEL will definitely be a beneficiary of that.
Okay, BEL and Reliance Industries, if I got that correct. What about a couple of these other themes like Indigo? If I look at some of the datas, barring aviation, other indicators are indicating some softness. It could be because of marriages. It could be because of the Kumbh Mela as well. That's happens once in multiple years. Your view on Interglobe Aviation? It comes out with a set of numbers, but it's corrected a fair bit from the top.
Well, I think the numbers are expected to be good because obviously the aviation turbine fuel prices have been under check, and that does help. Of course, also Q3 is a seasonally very strong quarter, so I'm reasonably confident the numbers will be good, and we may probably see a pop after the numbers come out. We have to see their commentary on international expansion plans, because that's going to be critical as well for the margin going forward. But having said that, I think, I'm not very comfortable with the valuation at which it is still quoting. So I will probably skip this. Also, I believe that aviation business is inherently extremely volatile. And, I'm not, in favor of buying Interglobe even at current levels.
Okay, that's Interglobe Aviation. I was just sort of rounding up the trends for the week, and it's very, very clear. Hi, Sudeep. Good afternoon. I was looking at the weekly tally, and the cuts that we've seen in platform companies like Zomato, in EMS companies, despite the midweek recovery, I mean, they're still going home with losses of anywhere between 8, 9%, 13% in case of Zomato. Let's quickly talk about these two sectors, which have finally, come off from the high. Would you be a buyer, either platform companies or say stocks like Amber, Dixon, Keynes?
Platform companies, yes, particularly Zomato, if you are specifically talking about it. They have very clearly said the margin expansion is being paused for the quick commerce business. And it's very natural with the kind of competition they are facing, with the kind of dark store expansion which they have outlined, and they need to do it. And under the circumstances, margins won't be going anywhere in the near future. And the market has punished it, probably rightly so. But this is all very short term. If we believe in the business, if we believe in the potential of the business, which I do, so for the medium to long term, I'm a buyer in Zomato. And these dips probably are an opportunity for accumulating Zomato if you are a believer in this space. As far as EMS companies are concerned, yeah, they have corrected. But I think the valuation still looks very stretched as far as I'm concerned. Even after correction, these stocks are not cheap. And if some stock is trading at a multiple of 100 or close to 100, then you're assuming that they will have a CAGR of 100 plus. So I think that's a little unrealistic. Yes, this area is fantastic. There is significant growth opportunity. We are scratching the surface. All that is fine. But that kind of growth, I don't see. So the valuation correction has happened. But I don't see still an opportunity of buying in these stocks.
Okay, all right. Got that. Sudeep, just hold on to that thought. A few stocks actually have come off the day's low. Shriram Finance. First look at it. The numbers appeared. It was a big beat, but there was a one-off out there. However, the street is taking a closer look at the numbers now, and that stock is more or less flattish. Similar is the case with AU Small Finance. I think initially look at the numbers, the stock took a bit of a downtick, but now it's recovered as well from the low point of the day. So I think we should pull that one up for you on the screen. Yes, now it's currently actually moved to the high point of the day. And Atul Limited, as we highlighted, there was a one-off out there. Well, that stock as well has seen a good recovery actually from the day's low. 100 buck recovery is what we've seen on that particular name. JSW Steel, numbers in the next few minutes, but likely to be post-market hours now. So we'll keep an eye on that. So we're going to break, come back, and we'll wind down the markets for you. Welcome back. The stock of the last 60 minutes has to be Loris. Sudeep, what's your view on this one? No more kicking the can down the road. They've gone ahead and delivered the margins. 20% is what they've delivered after nearly 6 quarters. So the street likes it. It's at that day's high. And it's been after a while that we can say that actually we'll want to get the management and push them a little bit more. Are things on the recovery from here on? But your take on the stock?
Well, absolutely right, Nigel. I think we have been hearing for too many quarters that the future is good and it was not coming. So finally, I think they have delivered numbers which the street has liked, and they are definitely good. Margin has finally moved up to that 20% plus kind of a range. The turnover revenue also has moved up. So let's see. I think we'll like to hear the commentary as well. But as far as the headline numbers are concerned, they do look good, and it's a relief as far as Laura's investors are concerned.
Okay, all right, got that. Well, we're down to the last 3 minutes. Sudeep, let's end on a silver lining. I mean, in every fall, there are lots and lots of opportunities. Give us one stock, one name that you will buy in this market environment.
Well, I think one stock which I've been recommending for some time and I'll continue to recommend is LIC. I believe there is a game-changing, regulatory changes are coming in the insurance space, and LIC has the potential to become probably one of the largest health insurance as well as general insurance players, along with being the leading life insurance company. Once the life insurance companies are allowed to sell general insurance and health insurance policies. So this is one space which I will definitely look at. The other thing is some kind of restriction on bank assurance as and when and if it comes. I think LIC will be unaffected, whereas all the other peers, leading life insurance companies, will be significantly affected because LIC's bank assurance is negligible. So again, LIC does benefit. So from a long-term investment point of view, LIC is one stock which I'll definitely recommend buying, from the investors' point of view.
Okay, all right, Sudeep, thank you very much for being with us and giving us all that stock advice. You have a great weekend, and we'd pick it up next week onwards. But right now we are down to the final minute of what's been another difficult week. 0.5% gone from the Nifty, like I said, but the mid-cap and small caps, they've lost a lot more. Let's look at today's tally then on the large cap piece. If we talk about the losers, Dr. Reddy's, Trent has lost. By the way, Trent is the worst performing stock on the Nifty this week. It's down about 12%. That's 4% today itself. M&M, Adani Enterprises, BPCL, Apollo Hospitals, these were some of the other weak names. And the big boys didn't shine today. Reliance is down 1.5%. Ditto for L&T. HDFC Bank is down about 1% as well. And let's look at ICICI Bank. That one's on the upside. ICICI has managed to retain a 1% up move, which also brings me to the upside of the screen. HUL, Britannia, Tata Consumer, very clear rush to safety here. These are, even if they're not growing too well, the cash-rich companies. And then there is, of course, IT, Infosys, TCS is where the bulk of the buying really was. Wipro also up about 0.5%. On mid-caps, however, Nigel, the cuts are much, much deeper, 1.5% lower on the index.
Well, that's right. A lot of stocks actually they just listed and they went flying away post-listing. They have pulled back. MobiKwik, just take a look at that stock. Down closer around 6%. For the week, it lost closer on 16%. From the top, it's down 30%. DAM Capital, another one that got subscribed numerous times, but that stock is coming for a pounding as well. Kalyan Jewellers, another week, the stock ends with a cut of around 9%. Keep in mind, just around 15 trading sessions ago, the stock was an 800 rupee stock. It ends at around 460 rupees or thereabouts. On the flip side, a couple of stocks did well. Jyoti Structures, we're talking about a slowdown, but they won a big order, 740 crores. That stock ended with a gain of around 10%. KFin up closer around 5%. The broader markets are a little bit wobbly, but that's the pain point actually. The Nifty, at least for now, lives to fight another day. 23,000 has been defended on a closing basis.
Absolutely, and that's the silver lining that we will take with us. It's a wrap on this edition of Closing Bell, but don't go anywhere because we have a very, very special offering coming up right after this break. Stock Market Confessions. Special one coming up with Prashant and Reema in just a bit.